Welcome to the Opalesque Institutional Investor Interview Series. I'm Mike Weinberg, Chief Investment Strategist for Protégé Partners. With me today I have Sean Bill, Chief Investment Officer of the Santa Clara Valley Transit Authority. Sean, in your primary role at the Santa Clara Valley Transit Authority, are there any material over or underweights within the last year?
With the recent drift down in rates, we decided that we need to look at our fixed income portfolio. And the expected return for the Barclays Agg on a 10-year expected returns going forward is about 2.5%. So we wanted to try to find some other alternatives where we could have a higher income.
Yeah, look, in light of the 30-plus year bond bull market, I think that's probably sensible.
Yes, at the Santa Clara VTA, we recently completed a strategic asset allocation, and we came back with a lower weighting to our fixed income allocation. So we went from 33% down to 25% in the fixed income space, and we also added high yield credit to that portfolio, which in the past had been a very high quality single A portfolio.
Sean, I know you're also on the board of the San Jose Police and Fire Department Retirement Plan. Are there any material over or underweights in that plan?
And there we took a more tactical movement on our portfolio. We went from 27% as our strategic asset allocation, and tactically we are currently underweighting it by 5 points or 5%. In
light of those material underweights or changes in allocations, what are you in turn overweighting?
At the San Jose plan, we are overweight the GTAA space. So we increased our allocation from 10% in GTAA, which we have split between 3 managers with GMO, Standard Life, and the PIMCO All Asset All Authority program. So we just basically bumped them up from 10 to 15. At the Santa Clara plan, we basically spread it around between real estate and other equity allocations.
Typically in GTAA, there's often a short book. Is there a short book in those, or is it primarily long only?
For the most part, they are long biased. PIMCO All Asset All Authority does do some shorting. They short. I believe currently they're presently short about 25% of the portfolio value in the S&P. But for the most part, the GTAA we view as not necessarily global macro, but more of a long, flexible mandate, but long biased.
Sean, it would be interesting to hear how your roles compare and contrast in terms of the two hats that you wear. Well,
I think that there's definitely a distinction between being a trustee of a plan and being a staff member supporting a plan. When you're the staff member, you are, whether you're the CIO or an investment officer or a senior investment officer, you're doing a lot of the legwork, writing a lot of reports, attending a lot of meetings. When you're a trustee, you're more focused on the big picture policy issues. So we're setting the strategic asset allocation. We are making occasional tactical shifts here and there. And then we are delegating everything from beyond there to the staff. So my role at San Jose, I'm at more of a high level policy perspective. At Santa Clara, I take the next level, the next cut below that, where we're actually working on the implementation of the board's program.
Are there other material tactical changes that you've made in either of the plans?
One area that we are presently underweight is the infrastructure sector. And this is really is not so much a function of a tactical bet as it is a situation of finding the right manager. And we have not been able to find the right manager. So we have a 3% allocation to the space with a 0% actual allocated.
And in terms of difficulty finding the right manager, what is it? Could you give us a little more color on that?
Well, it's an allocation that we had added to the portfolio in the last 12 months, where we've been really busy kind of rejiggering the portfolio generally, and it's just basically because it's such a small allocation, we had not yet gotten to it. I expect we'll probably do something there in the next 6 months or so, next 3 to 6 months. We do think that there's great opportunities in infrastructure globally, and that there's it's a great asset in terms of income generation. One of the things that we are very focused on at San Jose and Santa Clara is what Don Pierce at San Bernardino refers to as contractual income. We are big believers that we would rather place our fate in a contractual contract for income rather than waiting or being subject to movements in the principal that is determined by the mass markets of equities or public equities. So we are quite active in the fixed income space. We really changed our fixed income portfolio from what had been a traditional core plus mandate. Currently we have 5% allocation to high yield. That's split between Beach Point Capital in Los Angeles and Symphony in San Francisco. And Beach Point is much more of a deep value high yield manager. Symphony is much more of a trading manager. We think they pair up very well together. They complement each other well. In the emerging market debt space, we have a 5% allocation to Iguazu and Blue Bay. And then we have about 10% of our fixed income, or 10% of the portfolio, in opportunistic credit, which would be kind of your traditional direct lending middle market lenders. And so there we have, we had first started investing in that space back in 2010. We went with White Oak, Medley, and GSO. More recently, we have been investing in European direct lending managers. So we went with Capula and Park Square. $90 million with Capula, and I think Park Square was like roughly $50 million. We do think that there is a real dislocation in that space. One of the things that we do try to do is we try to approach the market from a thematic standpoint, and we do believe that with Dodd-Frank and the Basel III issues and regulation and the overregulation, that for middle market lending, you have the wind at your back. A lot of these companies that are 50 million to 400 million in EBITDA don't have a credit rating, can't get access to the regular banking market, are going through these middle market lenders. And for us, in 2010, we were generating 12, 13% annualized returns. As that space has gotten more popular, the returns are probably coming down at around 9 to 10 at this point. But we still are, big picture-wise, it's one of our favorite themes.
What are you doing in the alternative space?
We have quite a few different things there. So we look at alternatives as really just a structure. And so we start out asking the question, how do you make your money? Are you making your money in equities? Are you making it in fixed income, interest rates, or credit? And then we really don't care about the structure. If you're a traditional long-only manager or if you're a hedge fund. So if you look at the fixed income portfolio that we were just talking about, almost all of our managers are actually hedge funds in that space. We do have a couple of long-only. We have the Franklin Templeton Global Bond Fund, and we have Colchester Global Fixed Income Fund. And those are traditional long-only managers. But that's it in our fixed income fund, fixed income allocation. The rest of our managers are all hedge funds. Now we use them in the equity space as well. So we look at it as, where are we in the market cycle? We can look at Case-Shiller or CAPM. We can look at, Tobin's Q, whatever you want to use to measure. Where are you in the market cycle? Does it make sense to be long beta? Do we think we're at the lower end of the cycle where we just want to get cheap beta on and get good exposure that way? Or do we think we're at the higher end of the cycle, in which case we may want to have more long-short managers? So that's something we're trying to be active with. We recently hired a manager out of Japan, Horizon, which is a long-short equity manager in Japan. And then we have a couple here in the U.S. as well.
What is it that hedge fund managers could be doing differently or better from an operational perspective that would make it more conducive for you to invest more in hedge funds?
I think the biggest challenge for us in the pension space, and particularly in the public pension space, is the fee issue. We are managing or stewarding taxpayer dollars. And we do get a lot of questions in regard to the fees that the managers charge. So I think that any time that a manager can demonstrate an alignment of interest with the underlying principal, if you will, or the LP, whether that is, having a significant portion of their net worth invested in the fund, where we know that they're winning with us or losing with us, that helps a lot. If the fees, the 2 and 20 is very challenging for us to justify, because we do get a lot of pressure from outside parties that, it's like, hey, you could do this on Vanguard indexes for 2 basis points, and we say, well, no, there's a difference. We're looking for great risk-adjusted returns, and if we're getting great risk-adjusted returns, we're willing to pay for it. But it involves a lot of education, and I think that's something the managers can always help with. We do bring them in relatively frequently to talk to the boards, to talk to the sponsors of the plan, the active and members and retirees, and the city. We are still working out our risk management systems and trying to find good ways to utilize that information and see where are we getting over concentrated in positions through multiple managers. We do have the capability through Russell Investments to run overlays and to make adjustments as needed if we want to.
Have you looked at adding emerging managers to the larger plan to complement your established managers?
We have talked about that idea. Our first step was to try to get a program in place. And to, we're at about roughly, if you took our hedge fund interest across the platform, we're probably at about 30% in hedge funds, which is a pretty big allocation. Now, making such a big commitment requires big name brand funds that people can get comfortable with, that they, that we can show are institutional in quality and that are not at risk of a blow up or a headline risk, if you will, the classic headline risk. That said, we do feel that the strongest, the area where you're going to get the greatest, you're going to generate the greatest alpha comes from smaller managers. And that could be anywhere from 300 million to about 3 billion, we think is kind of the sweet spot. And so that I think that is something you'll see San Jose and Santa Clara eventually get involved in.
So in terms of your emerging manager allocation, have you considered using a fund of funds? Because despite the fact that obviously that's a larger plan, for that you might want to diversify away some of the idiosyncratic or manager-specific risk.
Yeah, I think that would absolutely make sense. I think that identifying manager talent, is a little easier as the funds get larger. I think the payoff is exponentially better if you can get in earlier, right, and ride that manager's growth curve, if you will. But it takes a lot of talent, and you need to have people that have done it, that have been doing it, that have learned from it, the mistakes of the past, and we don't necessarily want to try and learn on the job doing it. So there are places for outsourcing to experts, if you will. And I think that, when you're talking about emerging managers or smaller managers, you want to have a team in place that has the ability to identify those managers.
And are you getting the transparency from hedge funds that you would ideally like to see?
I think, for where we're at in our sophistication level, and we are evolving, I think, 2 or 3 years ago, San Jose did not own any hedge funds. Today we have a sizable presence in that space. I think 2 or 3 years from now, you'll see us have a lot more knowledge and a lot more capabilities in terms of looking into those portfolios and utilizing the information that can be provided to take a more holistic view of our combined portfolio. One of the challenges that we face is, on a risk management system, how much do you want to spend? How, you can spend, $250,000 to $2.5 million. How much detail, how granular do you want to get in the data that you're receiving from the funds? And do you actually have people on your team that can make that data meaningful to the decision makers at the board level? And this is another area that we're actually seeing some consultants step in to fill gaps for public pension plans. Because it is pretty, risk management is a very important role. And it is a role that you want some steady and consistent, leadership. And in the public space, we do, sometimes in that type of situation, it makes sense to hire a firm to get what you want.